My next guest, he called the market's turn to a T, a lone bull, now with a crowd cheering him on. Will stock prices continue to rise? Well, let's find out. We've got Rick Bensignor, Chief Market Technician at Execution. Good to have you with us, Rick. Yeah. You really did. You managed to call this, and you were all really kind of, it was an outlier call at the time. This was when? This is back in the early...
It was back in the June to July sell-off. We were kind of identified, I think it was July 16th, give or take a couple of days, that the market was not a short. A week earlier, we were on saying, yes, the market was going to be bearish. But I happened to come on your show 1 week later, I said, actually, no, it's not. It's going higher. And obviously, it's moved up a hell of a lot since there.
All right. And does it continue to move up, or are we just at the edge? Come on, tell us.
I can't tell you we're at the edge, but I'm thinking that we're probably, with S&P near 1100, we're probably in 7th or 8th inning of this. Maybe we push a little higher, 50 points, maybe 100 points. I don't really think we're going much more than that. So in Dow terms, maybe you get to Dow 10,150, 10,002. Not much more than that.
Why not? I mean, didn't you like the third quarter earnings? We got Google, we got Apple, we got the Yahoo earnings. You're not impressed by all this?
I'm not impressed because virtually all the names are beating the analyst estimates. So what good is it if every firm, and it's not absolutely every firm, but if the bulk of firms are beating analyst estimates, what type...
You're calling into question the whole sell-side notion of the market.
Yeah.
All right.
Yeah. As far as fundamental analysts, look, to me, I think there's a tremendous amount of herd mentality in that whole process. You always have a few outliers who, guys who are above estimates and beneath estimates, but you get your core kind of the fat part of the bell curve. Everybody kind of tries to center around there because they don't want to be too off where everything else is. And if last quarter numbers handily beat, this quarter, numbers are handily beating.
And the comps are pretty easy, right?
Of course. Oh, versus 12 months ago, of course.
Sure.
So what credence do you put into fundamental analysts' consensus estimates when they're clearly so beneath where the market really is telling them to be? So what's it say? It says they overshot on the upside initially in 07 and 08. It took them a long time before they finally lowered the number after the markets had sold off thousands of Dow points. And now they're too cheap, so the numbers are beating them. Probably another quarter or so, they'll really shoot them higher because they were too low, at which point it's time to sell.
Is this a race between time and actual acceleration in value? I mean, because, all right, we're in October now. We've got a couple months before the end of the year. Are people going to want to just kind of continue to put some cash into the market before the end of the year and wait and see what happens? Or are we going to kind of peter out before we get to December, do you think?
I think we actually peter out before we get to December. It wouldn't surprise me if by mid-November people start taking some risk off the table.
Why is that? Do you think just because they've got those
locking
nice gains,
profits,
locking the profits and locking the commissions and the fees right now?
Yeah, I think, look, a lot of there's talk that there's a lot of underinvested portfolio managers. I don't really see it that way. I was on a trip in London a few weeks back. Nobody said to me they were underinvested. They said we weren't necessarily in the right sectors with the right weights, but they had put virtually all their money to work. So
it's not as if people got a lot of cash burning holes in their pockets.
I think the public might, retail investors might, because they got burned twice in 10 years. I don't think they've really partaken much in this rally. And when you start having the media talk about how important Dow 10,000 is, I don't think it's important. Yeah, it's a big fat round number. But if you've waited from the Dow to go from 6,500 up to 10,000, and now you first say, oh, it's above 10,000, it's safe to come back in, I can't guarantee anything, but I'll make you a decent bet that you're within 10% of the high.
10% of the high. So where do you look for some value, or what do you do with the money now? Do you pull it out and start to put some of it away in bonds, or do you just sit and wait and cash until, are we going to get a correction then?
Good question. I think the last 6 months showed that cash is not king, and people were willing, certainly portfolio managers were willing to aggressively go back and take risk on. I do favor buying bonds. I do think rates will head lower. Recently, the U.S.
Rates heading lower?
Yeah.
How much lower can they get?
Well, considering we were at 2% last year, and then we moved up to 4%, I think we can easily...
On the long bond, right?
On the 10-year bond.
Yeah.
I think you could easily dip back under 3% over the balance of this quarter well into the first half of next year. So it wouldn't surprise me. We actually put out a recommendation to buy bonds just about 3 or 4 days ago with a yield between 3.43 and 3.5%. We got right to there. We back down to about, I think, 3.33 today.
Right. Well, you've certainly seen that in the muni market as well.
Yes.
A lot of sell-off right now. So does that mean that you're going for the bonds not only for the 3.5–4%, but you're looking for the principal return? You're thinking the prices are going to increase.
I think it's both ways.
Both ways.
Yep.
And any fears of inflation? I mean, take a look at the yield curve. I mean, come on. I mean, this is one of the steepest yield curves we've been able to talk about in years.
Look, I think money's still going to flow towards the back end of the yield curve as people were willing to take on risk. It's one of the reasons I like bonds, because nobody wants to take out a 3-month T-bill. It gets you nothing. So at least if you go out on the yield curve, you get something. That should help propel bonds slightly higher as people are still searching for yield. And it wouldn't surprise me if you see some narrowing in the 2s to 10.
What does that do to the U.S. dollar? We were just talking about it before you came on. You said it looks likely maybe we get a little dollar rally.
Look, today was the first type day where we saw a chance for this thing to get a little whiff of potential change of sentiment. I was looking for the dollar index to close today above 75.60.
All right, so we're at 75.50. Okay,
right,
we'll give you 10.
It's awfully close to it. Now, it doesn't mean that you just dump out of everything and come back in and buy the dollar, because if that happens, stocks are going to go way down. But if the dollar and the stock market are very sensitive to each other right now. Today, the intraday movements with the dollar index were exactly inverse to the S&P. Every time the S&P moved up, dollar moved down. When the dollar moved up, S&Ps moved down. If you get any sense at all that the dollar could make a turnaround here, and you can make an argument, but it's not a strong argument, and every argument anybody's made for the last 6 months lasted a week, and then the weight of the dollar fell on itself again. But if the dollar would get some type of bounce, then you're going to see pressure in stocks.